Good afternoon, everybody. Mike Overson, Illuminate Bank here. Thanks for joining us on U.S. Home Talk. We are here live every Wednesday, noon Central Standard Time, bringing mortgage and real estate current events to you. Today's topic, mortgage news and mustaches, baby. All three of us got mustaches today. Hence our topic. So we're going to cover a good amount of info today. A lot of it's going to be mortgage based, mortgage related, but we will field questions about our mustaches as well. That is fine too. To get a hold of us during the show, if you're watching us live on Facebook, you can simply just type in a question or a comment in the comment section on the Facebook live feed, and we will answer it live on air. You can also call us or text us on our real estate hotline number. That number is 612-234-7585. You see it scrolling at the bottom there. Again, 612-234-7585. And if you want to get a hold of us at any time during the week, the best place to reach us is our website, US Home Talk. There you will be able to connect with us 24/7. You can submit comments and questions through there. We actually are going to answer a question that came in during the week from US Home Talk here from one of our listeners. And we'll cover that first coming up here in a little bit. With me today, no stranger, obviously, to US Home Talk, Jason Walgrave Real Estate Group at RE/MAX Advantage Plus. Marcus Walgrave, who is typically with us, he's with the South Dakota Home Team, powered by Heg Realtors. He's doing something important today or something, right, Jason? He's always important. He's all month.
All month he's important.
He's got important stuff going all month, so he will not be with us today. But he is in the Sioux Falls, South Dakota market. We are up here in the Minneapolis, St. Paul metro area is where Jason and I are at. All right. Diving into our topic here. So the question that came in from one of our listeners earlier this week was, can you go through some of the acronyms that are used in the mortgage biz? So I'm guessing this person is probably actively going through the mortgage process now, like the home loan process, and you are going to see acronyms thrown around left and right. And I'll be honest with you, like us mortgage people, we don't realize that we're using those acronyms because we use them hundreds of times a day, right? It's just our normal language. But I can totally see someone going through the loan process like, what the heck is PITI? What are they talking about? What is PMI? What does LTV stand for? Right? All these things that me and Jason know because we talk about it all day long, every day. But if you're going through the loan process, especially if it's your first time, you're probably just like, I don't know what you're talking about, loan officer guy. You're going to have to explain it to me. So we're going to go through some of these. And actually, you know what? We can make this like a little quiz. We'll see how well Jason has been paying attention over the years on the mortgage stuff. So some of the acronyms that we use, the first one that sticks out is PITI.
PITI, that would be principal, interest, tax, and insurance.
There you go. So that's referring to like your full monthly payment, right? You got your principal and interest payment, but you also have property taxes you have to pay. You also have homeowners insurance to pay. So we just abbreviate that PITI when you're taking the full gamut, the full monthly payment into consideration. All right, next one. Quiz question number 2, Jason. APR.
APR, annual percentage rate.
There you go. And so this is a interesting one here because when you get a loan quote or a loan estimate, you're going to see an interest rate and you're going to see an APR and you're going to see an annual percentage rate. They're going to be different.
Yep.
Okay. Well, why the heck are they different? Like what's the difference? Why is there a different number there?
Because the first year's APR includes the closing costs.
Right.
Yep.
Exactly. So I explain it this way. If the interest rate you're paying on your loan, right? If you can get that interest rate for absolutely no closing costs, you don't have to pay any closing costs at all to get that interest rate, your interest rate and your APR would be exactly the same. Mm-hmm. But because there's closing costs that you have to pay in order to get a loan these days, right? Now what they do is they take the closing costs to get that loan, and they add it on top of the interest rate and display what an effective interest rate would be over the first 12 months because you got to pay those closing costs. Mm-hmm. So the actual effective interest rate you're paying year after year after year is the interest rate that you see there, right? So let's just say example 6.75%. Your APR might be 6.92%. And that's because of the closing costs being thrown in there for the first 12 months. That's why the APR is higher than the actual interest rate that you're going to be paying on the loan.
And Mike,
right.
that's a federal law to disclose that, correct?
Absolutely. Yes. Yep. the function of the APR is for a consumer to look at 2 quotes or 3 quotes or 4 quotes, right?
Mm-hmm.
And each one might have a different interest rate on them. Each one might have a different amount of closing costs on it. So it's like, well, how do I figure out which one's better? How do I actually go through these and compare these? The APR is supposed to be a one place where you can look at it. It's like, okay, this is the interest rate plus the closing costs. It's one box you can look at to kind of just compare the quotes down the line.
Mm-hmm.
So that's the actual function of it. That's why the federal government has it there. All right, number 3, PMI.
PMI.
Do you know what it stands for?
Do you think Evan? We should ask Evan this one. I think he knows of this one.
Evan, do you know this one? PMI?
Principal mortgage insurance.
Yeah.
Close. Private mortgage insurance.
Damn.
It's not principal mortgage insurance. It's
that's
private
close.
mortgage insurance.
Close
Yep.
enough.
Yep. So PMI, that's the insurance that you have to pay if you have less than 20% down. And we're talking about conventional loans here. On FHA loans, you have to pay PMI regardless of how much you have down. And that's just the way they work their mortgage insurance on there. But on a conventional loan, you pay your PMI unless you have 20% down. If you have 20% or more down from the get-go, you don't have to pay PMI.
Is there, Mike, a PMI payment option that is not monthly? Can you pay it all up front?
You can. On a conventional loan, yes, you can. So there is the standard monthly option that you can pay, or there is a one-time payment you can pay. So you pay just a one big chunk of money at the time of closing, and then you don't have any monthly PMI to pay there. And that's only on conventional loans. You cannot do that on FHA or any other type of loans. It's only available on conventional. So, but PMI, it's one of those things I tell it, its better name should be called default insurance.
Yep.
That's what it should be called.
That's what it
Because
is.
it's an insurance policy there just in case you default on the loan, then the lender can file a claim against that insurance policy and help cover their losses, when they go through the foreclosure process.
So that brings the question: what's the riskiest loan out there? It's got to be the one with the least amount of money down,
Right?
right?
You would
I mean,
think.
if you're only putting 3.5% down, that's got to be the riskiest loan.
You would think so, right? Common sense would say that. No, but let's see. Let's see if Evan remembers the riskiest loan out there for a lender. Evan, so down payment wise, what's the riskiest loan that a lender can make based on the down payment of a client?
This feels like a trick question.
Your spidey senses are
Yeah,
correct.
we've definitely talked about this before. It's when it's just over the PMI amount, right?
So 20% down.
Yeah, like 20.01 essentially, right?
Yeah, basically anywhere between 20 and 24.99% down. So basically the 20% down payment is actually the riskiest loan for a lender to make out there. And well, why is it? How is a 20% down payment riskier than a 5% down payment?
No insurance.
Right. The 20% down, a lender cannot require the buyer to get PMI or private mortgage insurance. Okay. Now with 5% down, the lender can and will require that person to get a mortgage insurance policy. That mortgage insurance policy of 5% down will cover probably 30%. Okay. So you take the 30% insurance coverage that they have here, plus your 5% down in the lender's eyes, you got 35% down.
Yep.
Right.
Yep.
And so with a 15% down payment, you typically get 10% coverage, I think, 10 to 15% coverage. So again, it looks like 25 to 30% down by the time you take the down payment plus the PMI coverage on there. 20% down, no mortgage insurance, right?
Nope.
Strictly just down payment. So in the lender's eyes, right, that's a 20% down payment deal. It's actually the riskiest loan for a lender. So, which means typically what happens as far as interest rates go then, Jason, if you have 20% down?
Well, interest rates should be lower than if you're only
Should
putting
be.
3%. Yep.
Should be, but they're typically not. Typically, your interest rate with a 20% down payment is just slightly over any other down payment amount.
Now, what if you go to 25 or 30%? Then you're going to have an interest rate break.
Yes, then you'll have a
Yep.
break in your interest rate. Yep. But that 20% to 24.99% down, that's the bucket there that'll have probably the highest interest rates on them.
Got it.
Now, we're not talking anything crazy, right? Might be 1/8 of a percent higher.
Sure.
That's it, right? Nothing crazy, but nonetheless still higher than the other ones. And that doesn't make sense to a lot of people, but it's all about the mortgage insurance, right? It's all about the risk to the lender. Risk to the lender, higher risk means higher interest rate, right? So, Okay, so let's move along here. So we have the next one, LTV. LTV.
Loan to value.
Loan to value. There you go.
Yep.
Right? So it's basically how much of a loan are you borrowing against the value of the house.
Mm-hmm.
So that's what LTV stands for there. Pretty easy to understand. ARM. ARM. ARM.
Adjustable rate mortgage.
There you go. Adjustable rate mortgage. So there's FRM, fixed rate mortgage.
Mm.
And there's ARM, also known as ARM, adjustable rate mortgage.
FRM.
So,
I don't know that I haven't heard that before. I mean,
everyone just says fixed rate, right?
Yeah,
Everyone just says
yeah.
30-year fixed. It's
Yeah.
never like a 30-year fixed rate mortgage, you know.
Yeah.
But people will say a 5-year adjustable rate mortgage. They'll say a
Yeah.
5-year adjustable rate mortgage, but on a
Yeah.
fixed side, they usually just say, oh, it's a 30-year fixed.
Yeah. Huh.
So you don't see FRM a whole lot, but it's out there. FRM and ARM, fixed rate mortgage versus adjustable rate mortgage. And then the last one here, DTI.
Debt to income ratio.
There you go. Debt to income ratio. So that is the measure that lenders use to figure out how much of a loan someone can borrow, right? So they look at your total income coming in. Here's the monthly income coming in from all the sources that we can use for income. And here's all the monthly payments that are going out, right? The mortgage, the expected mortgage payment that you're looking to qualify for, your auto payments that you have going out, your credit card minimum payments, student loan payments, you know, things like that. So they look at the income coming in and the income going out. And then they run a calculation called the DTI, which is your debt to income ratio. And then that's how lenders figure out how much someone can qualify for.
Yep. It's good.
And it's super fun, right? We could do a whole show. We could talk 2 hours about acronyms. And everyone would be sleeping.
Though. It's a great question from a listener to the show. I mean,
It is.
Because we throw them around, like Mike said, we throw them around all day long, and we kind of forget, that it's not common. It's not common knowledge to know what they mean unless you're in the industry. So, great question. We appreciate answering it.
Absolutely. All right, going to our next topic here. So the second topic here of our show, we got mortgage news and mustaches. We're not going to talk about mustaches today, a whole lot, a little bit. The next thing we're going to talk about is going to be possible sources for your down payment, right? So someone going through the loan process there. We just covered the acronyms that you might run into, and then let's cover some possible sources for down payment. People think, I got checking and savings, right? That's all I got. Right. Yep. Checking and savings, that's my only chances there. So I just got to save more money or something like that. Not necessarily the case when it comes to finding sources for down payment. So I have five different sources here.
Mike, should we do legal minute first?
We do have the legal minute. Yeah.
Let's hammer that out.
This is Jeff O'Brien, attorney with Hush Blackwell with the U.S. Home Talk Legal Minute. Revocable trusts are a common estate planning tool. Many people use them as a way to avoid probate upon death, provide efficient incapacity planning, and for general asset management. Oftentimes, real estate is transferred to a revocable trust, whether it's an investment property, lake home, or homestead. However, take caution before automatically transferring your Minnesota farm to your trust. This is because Minnesota's corporate farm law restricts business entities, including trusts, from engaging in farming or having any type of interest in agricultural land unless the trust qualifies for an exemption or otherwise satisfies the requirements of the statute. The purpose of the law is to encourage and protect the family farm and well-being of rural society in Minnesota and the nuclear family. The first step is completing the Minnesota corporate farm application. If the trust satisfies the requirements of the statute, the Department of Agriculture will deem the trust to be in compliance with the law. Take note that annual filings will be due thereafter. No fees are incurred with any of these filings. This is Jeff O'Brien, attorney with Hush Blackwell with the U.S. Home Talk Legal Minute. This is Jeff O'Brien, attorney with Hush Blackwell with the U.S. Home Talk Legal Minute.
Almost had an encore there.
Legal 2 minutes.
He just wanted to keep.
He just wanted to. I tell you what, if you, I feel like I'm kind of smart. Like I feel like I'm a smart person.
I think you're smart.
And then Jeff starts talking about that stuff. I'm like, yeah, I'm not as smart as I think I am. Guy knows his stuff though.
Yes, he does.
All right, moving along here. So sources of down payment that we started talking about. Of course, the first one here that I'm going to talk about is checking, savings, and CDs, right? Just money that you have stashed away. You can certainly use that for down payment. The one thing that you cannot use for down payment, if you stash your money away in your underwear drawer, your sock drawer, maybe in a shoebox in your closet. Yep, mattress. Straight $100 bills, straight cash, cannot be used. Cannot be used to purchase real estate. Any dollar used to purchase real estate has to be able to be documented correctly.
Mm-hmm.
Cash, you typically can't document correctly. Can you take a picture of it laying on your kitchen table? Yes, you can. Is that going to meet any sort of federal guidelines for documenting where that money came from? Absolutely not.
Nope.
Nope. So
Nope.
if you have cash, speak to your loan officer. There are ways around that. There's ways to get around that and be able to use that cash. But you can't just show up with a paper sack of $100 bills and be like, let's buy a house. Can't do it. So checking savings and CDs, that's number one. Number two, 401k loan. Okay. I love the 401k loan for down payment for down payment option. And here's why. There's no closing costs to get a loan from your 401k. Okay.
Yep.
It's not a taxable event, so you don't have to worry about any sort of taxes they have to pay on it. Now, is there interest on the loan? Yes, it's a loan and there's interest, but the interest you pay goes back into your own 401k, right? So you're paying interest to yourself, right? No big deal. Fine, I'll pay myself a little bit extra money. Great. You got more saved up there then. Okay. So the 401k loan is great. It's nothing to fear at all. I have a ton of people that do it. And the payment terms are reasonable on it too. You can typically go up to a 15-year repayment term on it.
Nice.
And so the payment keeps the payments low, and they usually just take the payments right out of your paycheck.
Yep.
So you don't have to write a check out for it. It just comes out of your paycheck and you're good.
I like it.
So number three, so we're going to talk about IRAs, right? So you can also quasi do a loan from an IRA. It works a little different though, right? So if you have an IRA out there, you can withdraw the money from an IRA. You can't do a loan against it, but you can withdraw the money from an IRA, right? And there's no taxes, there's no fees, there's no penalties to pay if you replace that money within 60 days. Okay? If you take the money out and it's past 60 days and you have not replaced that money back into the IRA at that point, then you are subject to taxes, fees, and penalties. Okay? So you can use it for a short-term deal. I've had people use it to say, you know what? I got a house to sell. I know it's going to sell quickly. This is what I'm going to do. I'm going to take money out of my IRA and use it as down payment on the next house. And I'm going to go buy my next house first and close on it. Okay. Then I'm going to sell my current house. Once my current house sells and I have those funds in my hand, I go pay my IRA back.
Yep.
Okay. So that's one possible way to do it there. But it is an option. Again, as long as you replace that money within 60 days, there's no taxes, no fees, no penalties.
Excellent.
Next one, gift from family. Right? So you can get gift funds from family. And it can be just, a cash gift. Again, can't be $100 bills, right? We have to document it going from one account to the other. But you can get monetary or cash gifts from family members, and you can use that. Every loan program out there does allow gift funds to be used.
Good.
Right? So lots of options there. You can also do what's called a gift equity. Right? So gift of equity from family. So how does that work? So a gift to equity is, let's say a parent is going to sell a house, their house to one of their children. Okay. And let's say this house is worth 400,000, but the parent is just like, you know what, just give me 300,000 for it. We'll call it even.
Yep.
Okay. So the house is worth 400, kids buying it for 300. There's $100,000 equity in that house. What's going to happen to that equity? Right. So the parent can basically just say, look, we're going to write the purchase agreement for 400,000. So I'm still going to sell a house to you. On the paperwork, it's going to show a $400,000 sales price, but I'm going to give you $100,000 worth of equity. So all you got to do is a loan amount of $300,000.
Yeah. It's a great option.
So good, right? Because then now in the bank's eyes, it's like, okay, you're borrowing $300,000 against a $400,000 house. Okay.
Yep.
It looks like you have a 25% down payment already because of
Yep.
the $100,000 in equity there. Money doesn't have to exchange hands. The equity just stays in the house. And so therefore on the bank side of things, it's like, okay, you got 25% down in our eyes, no mortgage, no PMI, right? No mortgage insurance, interest rate's good, and blah, 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 all that stuff. So it works out slick. Now the gift to equity thing does only work from family member to family member. Okay. So just keep that in mind too. You can't have just a random seller do a gift to equity to another unrelated buyer. That does not work. But if it's family to family, absolutely do the gift to equity.
Awesome.
And then the last one, grants and down payment assistance. So I know, Jason, we were talking about that a little bit earlier here. Each city, each county, each state has their own programs. They all work a little bit differently, right? Some programs come and go. It's like, hey, a city has $100,000 to give out for some sort of grant program or some sort of down payment assistance. So we're going to give 10 $10,000 grants out, right? Once they're gone, and then that program's gone. So programs can come and go. But like the state of Minnesota, we do have a program here, which is run by the state called Minnesota Housing, or MHFA. They never run out of money. It's always there. So we always know that we can go to the state program and get down payment assistance for people. But that's another great thing to check on, is check your local, check your city that you're looking at buying in, check the county you're looking at buying in. There might be a program out there that can benefit you, and you might be able to use that for down payment.
Lots of great options, folks.
Absolutely. So that's everything on my list. You got anything, Jason? Mustache?
No, it's a great show. Hey, the Mortgage Mustache Mike this morning.
Love it. Well, we appreciate everyone tuning in. We appreciate the listeners submitting their questions throughout the week. If you want to get a hold of us during the week, reach out to us at ushometalk.com. Other than that, we will be back next Wednesday with another live show. We appreciate you tuning in. We'll see you next week.